Hi everyone, in this video we'll be going over A-Level Accounting 2023 October-November Paper 2-2, question number 1. Paper 2-2 consists of 4 questions and 2 of them will be of 30 marks and 2 of them will be 15 marks, and the time limit that you'll be given for the entire paper will be 1 hour and 45 minutes. Since question number 1 is of 30 marks, ideally you should be spending about 35 minutes in order to complete this question, and in this video as well we'll be attempting to solve this question within 35 minutes. So without any further delay, let's get started. P Limited sells electronic goods online. The directors provided the following information. So we have information at 1st August 2022 and 31st July 2023. So these will be our opening balances. These will be our closing balances. We're given information regarding debenture, inventory, other payables for administrative expenses, other receivables for administrative expenses, other receivables for distribution costs, and trade payables. Then we're also given the bank account extract for the year ended 31st July 2023. We're given the payment section where the payments has been made to credit suppliers. So these are the payments made for credit purchases. Then we have payments for administrative expenses and the payments for distribution costs. For receipts, we have the receipts from customers. So these are the amount that we received from credit sales. Then the following information is also available. All goods are dispatched to our customers immediately on receipt of payment. So whenever we receive payment from our customers, we immediately send them the goods, which means that the total amount of sales is just going to be the total receipts from customers. So this amount of 284,200 is going to be our amount for sales. Then inventory at 31st July 2023 included damaged items that had cost 3,600. So if we have damaged items, we cannot really sell them anymore, which means that we need to subtract its cost. So let's figure out the correct value for our closing inventory. We can start with the amount given. So we have the closing balances right here, and for inventory it's 43,190. Now, since we cannot really sell damaged items, we need to subtract its cost. So that's minus 3,600. Then 1/2 of these items will be scrapped and have no value. Okay, so 1,800 worth of goods cannot be sold anymore. It has no value at all. Then the remaining items will be sold for 900 after repairs costing 420. Remember that our International Accounting Standard 2 always states that the inventory should be valued at the lower of cost and its net realizable value. So the net realizable value is the amount that we can actually make by selling the damaged inventory after deducting its repairs cost. So in this case, we can make 900 by selling the damaged inventory, and our repairs cost is 420. And this gives our net realizable value to be 480. And again, remember the statement, inventory should be valued at the lower of cost and its net realizable value. The cost is 3,600. The net realizable value is 480, which means that the lower is net realizable value. So this should be the value of our inventory, which is why we subtracted the initial cost. Now we will be adding our net realizable value of 480. And this gives the correct value for our closing inventory to be 40,070. Now, 8% debenture, which is to be repaid in the year 2026, was issued on 1st April 2023. Remember, our closing date is 31st July 2023. So let's calculate the number of months that we utilize this debenture for. So we're starting in April, May, June, July. So that gives us 4 months, which means that the interest on this debenture will also only have to be paid for those 4 months. Let's figure out the interest on debentures. We start with the amount for debenture, which is given to be 36,000. We're given the rate of interest on debenture to be 8%, but this will give our interest on debenture on an annual basis. So this will be the interest for 12 months, but we have only used the debenture for 4 months. That is why we'll be multiplying it by 4 and dividing it by 12. So we're basically utilizing our unitary method here. This will give our interest on debenture to be 960. Then the charge for taxation was estimated to be 10,700. All right. Now we need to prepare the statement of profit or loss for the year ended 31st July 2023. We need to use the space provided to show our workings. Okay, we need to show our workings for cost of sales, administrative expenses, and distribution costs. This is a statement of profit or loss, which means that we first start with our sales value. And we've already concluded that the total receipts from our customers will be our total value for sales. So that's just going to be 284,200. We then have to include our cost of sales. And we need to show its calculation below. So remember that cost of sales is just going to be our opening inventory plus purchases minus the closing inventory. We've already figured out the correct value for closing inventory. We are given the opening inventory value. Now we just have to figure out the value for our purchase. And in this case, we have the payments that we made for our credit purchases. Then we are also given the opening and closing balances for trade payables. And remember, whenever we're trying to figure out the value for credit purchases, we start with the payment made to suppliers. Then we subtract the opening trade payables. We subtract the opening trade payables because this is a value that was raised after making a credit purchase in the previous year, which means that this is the amount of credit purchase for last year, which should not be included in our current valuation or current financial statements, which is why we'll be subtracting it. Then we'll be doing the opposite for closing. So we'll be adding closing trade payables. We're adding this value of 25,250 because goods worth the amount of 25,250 was purchased in this year, but we were not able to pay the supplier within this particular year. But regardless, this is the amount of goods that had been purchased within the current year, which is why we need to include it within our valuation for credit purchases. Okay, that is all. Let's start with the payment made. That's 122,050. We need to subtract the opening trade payables, which was 29,610. Then we add our closing trade payables, which is of 25,250. This will give the value for our credit purchases, or the total purchases in this case, to be 117,690. Okay, we have our opening inventory to be 36,800, and we figured out the correct value of closing inventory to be 40,070. Now we can easily figure out the total for our cost of sales. So the opening inventory was 36,800. We figured out the purchase to be 117,690. Then our closing inventory was 40,070. Now this gives the correct value for cost of sales to be 114,420. Now we need to subtract this amount from our sales in order to get the value for our gross profit. So that will be 284,200 minus 114,420, which is 169,780. All right. We are not given any other income because remember, in our receipts section, we only have receipts from customers, and this is the value that we received for sales. So we can move towards our overhead section. And we are given overheads for two different headings. We have administrative expenses and distribution cost. Now, this is the amount that we actually paid out for the administrative expenses, but we also have to make adjustment for other payables and other receivables. Okay, let's look at the payables first. We only have the opening payable value. This is the payable for last year. So this is basically the overhead that was incurred at the closing date of 31st July 2022. So since this is an overhead of last year, we should not really be including this amount in our current year, which is why we will be subtracting it. Now let's move towards the receivables. We have receivables of 1,820 at the opening date. Since we're talking about receivables, this amount at the opening date will reflect the prepayment amount. So this amount is actually for the year ended 31st July 2023, which is the current year, but it was paid in the previous year, which is why we will be including this amount. Now we have our closing receivables for administrative expenses of 160. This again refers to the prepayment made for the year ended 31st July 2024, which is the future year, but we paid 160 in the current year. Regardless, this is not an expense for the current year, which is why we should not be including this amount. So we'll be subtracting 160 from the initial amount of 66,920. Let's show this working below. So we start with the amount that was given in our payment section for our bank statement. So that was 66,920. Then we had the opening payables for administrative expenses. So we subtracted. Regarding the opening receivables for administrative expenses, we added. Then we subtract the closing receivables for administrative expenses. So that's minus 160. This will give the total for our administrative expenses to be 67,620. Let's write it down. Then our other expense was our distribution cost. So again, we start with the amount given in our payment section. So that's 51,730. Then we need to adjust for the other receivables of distribution cost. Again, the format is similar to what we did for administrative expenses. We will be adding the opening value, which is not given in this case. Then we'll be subtracting the closing value. So we just need to subtract 1,490 from 51,730. Let's do that. So we had the given amount of 51,730. Then we need to subtract the amount 1,490. And this will give the correct distribution cost for the year to be 50,240. Let's write it down. That was 50,240. Now we need to subtract these overheads from our gross profit in order to get the profit from operations. So that's going to be 169,780 minus 67,620 minus 50,240, which results in our profit from operations to be 51,920. Now the next step would be to subtract our finance cost, and finance cost is basically the interest charges. In this case, we had to pay the interest on the debenture, which we calculated to be 960. So this will be the finance cost. Now we need to subtract the finance cost from the profit from operations so that we can figure out the profit from taxation. And in this case, we're not using the term profit for the year, but we are using profit from taxation because we are given the value for tax as well. Now the profit from taxation is going to be 51,920 minus 960, which results in 50,960. Then we will be subtracting the amount for our tax, and it is already given in the question. That's 10,700. Let's subtract it. Now we can use the term profit for the year. And this is going to be 50,960 minus 10,700, which results in 40,260. This completes our statement of profit or loss. Let's move towards the next part. We're given the additional information. We have the balances at 1st August 2022, which is again our opening balances. Then we're given other information as well. And based on these information, we need to prepare the statement of changes in equity for the year ended 31st July 2023. Alright, let's start with the first one. On 1st September 2022, a bonus issue of shares was made of 1 ordinary share for every 6 shares held. So for every 6 ordinary share, we're providing 1 new bonus share. So the first thing that we need to do is figure out the number of ordinary shares we have. And in order to get the number of ordinary shares, we just have to divide the total value of ordinary shares by the nominal rate. So in this case, at the opening date, we have the total value of our ordinary shares or share capital to be 120,000. And the nominal rate is 0.5. This gives the number of ordinary shares to be 240,000. So we have 240,000 ordinary shares. Now let's utilize our unitary method. For 240,000 ordinary shares, we'll be providing 1 by 6 times 240,000 bonus shares. So this is going to be 40,000 bonus shares. Now the value of bonus shares is just going to be the number of bonus shares multiplied by the nominal rate, because remember the bonus issue is funded by our reserves, which means that we cannot really give out bonus shares at a premium price. This will give our value of bonus issue to be 20,000. Okay, let's write it down. We can write it under the heading of bonus issue. And the value for the new bonus share is 20,000. So this is to be added into our share capital, but we have to subtract the same amount from our reserves. So we first take a look at our share premium, but the total amount in that reserve is only 19,000. So we cannot really subtract 20,000 from 19,000, which is why we'll subtract the amount that it can sustain. And then the remaining amount should be subtracted from our retained earnings. And always remember that the total column for bonus issue will be 0. Okay, we're done with the second information. Now for the third one, on 1st January 2023, a final dividend of 0.07 per share was paid on all shares in issue at 1st August 2022. So this date is before the date of 1st September 2022, which means that we do not include the number of bonus shares for this final dividend. So we only give out the dividend on our initial number of ordinary shares, which was 240,000. Let's figure out the value for final dividend. That is just going to be the number of shares, in this case 240,000, multiplied by the rate per share. So that's 0.07. And this will give the dividend amount to be 16,800. And always remember that dividend is paid out from the retained earnings. So we need to subtract this amount from our retained earnings column. The total will be the same. It will have no effect on our share capital and share premium reserves. And we can just term it under the heading of final dividend. Okay, we're done with the third information. Then on 31st March 2023, a rights issue of 1 ordinary share for every 4 shares held. So in this case, for every 4 ordinary shares we have, we're providing 1 new rights shares. And this is at the date of 31st March 2023, which means that before this date, we have our initial number of shares as well as the new bonus shares. So the total number of ordinary shares in this case will be 240,000 plus 40,000. So that's 280,000. Again, let's repeat the same process. We utilize the unitary method. So for 280,000 ordinary shares, we'll now be providing 1 by 4 times 280,000 rights shares. That's going to be 70,000 rights shares. And this was made at a premium of 0.15 per share. So if we're talking about our ordinary share, the value for it will be the number of rights shares multiplied by the nominal rate, which in this case is 0.5. This will give the value of 35,000. So 35,000 should be added to the share capital column. Now we also have to calculate the same thing for share premium. That will be the number of rights shares, which is again 70,000, multiplied by the premium rate, which is 0.15 in this case. So that will be 0.15, which gives the total value of 10,500. Okay, we can write it down under the heading of rights issue. This will bring additional 35,000 to our share capital and additional 10,500 to our share premium. And for the total column, that will be 35,000 plus 10,500, which results in 45,500. We're done with the given information, but remember, within our statement of changes in equity, we always have to add the profit for the year to our retained earnings section. And we have already figured out the profit for the year from the first part of this question. And the value was 40,260. We need to add it to the retained earnings column. Okay, that will be all. Now we can figure out the closing balances. So that will be at the date of 31st July 2023. For our share capital column, that will be 120,000 plus 20,000 plus 35,000, which results in 175,000. For our share premium column, that's 19,000 minus 19,000 plus 10,500, which results in 10,500. For our retained earnings column, that's going to be 23,560 minus 1,000 minus 16,800 plus 40,260, which results in 46,020. Then for the total column, that's going to be 162,560 minus 16,800 plus 45,500 plus 40,260, which results in 231,520. This completes our statement of changes in equity. Let's move towards the next part. We need to state 2 examples of revenue reserves of a limited company. So revenue reserves are the reserves that is earned or collected from our main source of revenue, which in this case is making the sales. And from our statement of profit or loss, we calculate the profit for the year. So that is our main source of revenue, which we can utilize in order to expand the business or pay out dividend to our shareholders, right? And we include that profit for the year within our retained earnings. So the retained earnings is our first example of revenue reserve. And remember, there is also general reserve, and into our general reserve we put money from the retained earnings itself. So we can classify the general reserve as revenue reserve. Okay, this completes the third part. Now for the fourth part, we need to advise the directors whether or not they were correct to make a bonus issue of shares rather than make a new issue of shares. So basically, we have to compare the differences between the bonus issue of shares and new issue of shares. This is of 7 marks. Alright. So the very first thing is that bonus issue will incur no additional cost because we're providing the shares to existing shareholders. We do not have to make a call to potential shareholders in this case. But if we're talking about new issue of shares, it will be more costly because we need to inform about this issue to potential shareholders as well. And it will be costly in order to source such new shareholders. Let's write it down. Bonus issue of shares will incur no additional costs, but new issue of shares will be costly to source new shareholders. Okay. The next thing is that bonus issue of shares will be received favorably by existing shareholders because again, it is only being provided to the existing shareholders, which means that there will be no dilution in ownership. But if we're talking about a new issue of shares, any new shareholder can join the company now, which means that it will result in dilution of ownership, which might be taken well by the existing shareholders. Let's write it down. Bonus issue of shares will be received favorably by existing shareholders but it might not be the case for new issue of shares as it may lead to dilution of ownership. The next thing that we can write about is that bonus issue is being funded by our reserves. So there will be no cash inflow from our bonus issue, but if we're talking about new issue of shares, it will definitely raise new finance since the shareholders will be investing money into the business. Let's write it down. There is no cash inflow by a bonus issue of shares but a new issue of shares will raise new finance. Okay, now based on these factors, we can make a decision. So personally, I would say that the directors were correct to make a bonus issue of shares rather than a new issue of shares because bonus issue of shares will make use of our share premium account, which would have remained idle if we had made a new issue of shares. So let's write it down. The directors were correct to make a bonus issue of shares as it makes use of share premium account. Alright, this concludes the fourth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.